Ladies and gentlemen, thank you for being with us this afternoon. Quantera Global's Anas Lorenas and Rudolf Sinks, that is me, will be presenting the transfer pricing implications of Brexit for you with a transfer pricing angle, or at least a tax angle, obviously from a UK perspective, but as we are about to discuss transfer pricing, there's obviously other countries involved, and we're about to take you through those implications from a UK and continental Europe perspective. Next slide, please. Thank you, Nart. Nart is helping us out on the technical matters of this very webinar. If you have any questions, please do raise them. There is this sidebar to the screen that you can activate with one of the buttons on top, addressing a question that you may have, and we will certainly address your question, hopefully throughout the series or towards the end of it, or separately through an email also. Speakers of today indeed is Arnas and Rudolf. Arnas is located in London, hence his position in this webinar. Rudolf, together with Nart, working out of the Netherlands. Next slide, please. So before handing over the presentation to Arnas, ladies and gentlemen, an agenda of today. We will briefly talk you through the tax trends in UK of the current setting early March 2021 already. Current focus of HMRC and HM Treasury. The transfer pricing statistics that may be a bit of a surprise to continental listeners of today. The BlackRock case of last year, definitely worthwhile briefly listening into that. And a case study on the Brexit restructuring implications with a relatively simple, but then again, useful case study that we have thought of. Questions and answers toward the end of the program, but that may also happen throughout the presentation. So again, thank you very much for being with us. Arnas, perhaps you can introduce yourself and get started with the presentation. Thank you.
Hi, Rudolf. Hi everybody. I'm Managing Director of Quantera Global Office in London. I'm saying hi from a sunny London, which is always a nice experience. I see that me and Rudolf opted for different attires. So he opted to get a jacket. I opted to wear a tie, which is like, I think right now we have so few opportunities to wear a tie that I thought that it's a good enough reason to do that. Yeah, me and Rudolf work together already for over 10 years, although I did do a bit of a break and we parted for a bit. For the last 4 years, I've been with Quantera Global and working in UK, which is definitely an interesting jurisdiction to be in. I think the name of the slide is tax trend in UK. So I think what Brexit has done is maybe to some extent exemplified and fast forwarded some of the trends there, and we'll get into that a bit more. What we will talk about, let's say, a very specific Brexit case study and get into the implications a bit more, but we thought that it will be good to talk about the overall position of the UK jurisdiction and potentially the approach HMRC is taking and the government is taking in the recent years and definitely going forwards. We're doing this webinar in a very interesting moment, meaning one day before the spring budget. I think it is actually a good time to assess what has happened so far and maybe make a few predictions, but I guess there has been prediction is a difficult game to play, or difficult to be right, but we'll try to tie in what has happened before and what we would expect to happen going forward. In terms of the trends relevant for transfer pricing in the UK, let's especially after Brexit, let's maybe separate those out into 4 categories. And then, you know, there's a definitely agenda on digital economy, where UK takes a strong positions in some cases. There's deregulation after Brexit, or maybe refinement of regulations, which was on top of the government's agenda as part of the benefits of Brexit, and we'll get deeper into that. There's obviously some downside in Brexit, and also, let's say, the COVID impact, which we can discuss, and the way the government is responding, and HMRC is responding. And we'll also talk about the continuous pressure HMRC has on the MNEs, as it, I would say, you know, maybe they would say they're tackling aggressive tax planning. I think the position sometimes feels that HMRC is aggressively tackling tax planning, which is a word positioning, which makes all the difference. But we can take into the details as we discussed. In terms of digital economy, I guess it's no surprise digital service tax is a big question. UK was one of the first countries to introduce it and make it effective as of 1st of April 2020. There was obviously Pillar 1 and 2 discussions on which UK was committed to let's say, keep digital service tax temporary as long as the Pillar 1 and 2 is introduced. Obviously, there was a bit of a delay based on the US response, but effectively, digital service tax is being applied right now for the multinationals, big tech multinationals operating in the UK. US, interesting enough, chose the UK DST regime to investigate into, and recently they found that that some elements of this regime are unreasonable, discriminatory, and burdensome. I guess no surprise there in terms of the position from US side, but I think that kind of, as we go into Brexit, there will be an interesting interplay between the trade talks with the US, the DST position, and let's say Pillar 1 and 2 discussions, which effectively still are hanging on the position from US, and maybe we can also discuss a bit more with Rudolf once we get into questions and answers. Maybe just a quick response from you, Rudolf. What do you think? What is the perception on digital service tax in Netherlands, and in terms of the Pillar 1 and 2 discussions, and maybe the position UK is taking, which is definitely on the forefront of the digital service tax and digital economy discussion?
Yeah. Thank you very much, Anas, on this one. I think that the latest news that we all have received is that the US seemingly is taking a position more towards a solution on the Pillar 1 discussion, rather than holding back on this. News of this very week still. That obviously means that Netherlands and also other European countries are now again starting on a path on really investigating Pillar 1 on top of Pillar 2, which is not that cumbersome in terms of the transfer pricing mechanics. We do feel that ultimately, at least multinationals seem to feel, let's talk this manner, that something may need to be considered in terms of taxation of certain regions, jurisdictions in which they are not truly active in, at least not in the classical sense of the word, through permanent establishments and so on. The most critical part, I think, still is any position that may give rise to double or even triple taxation. That's really critical. And I think also that unless this is obviously top of our mind, it's even the first item on the today's agenda, this may certainly still take a while until Pillar 1 certainly has been embraced by the majority of countries. That may still take several years, most likely. Back to you, Anders. Thank you.
So I think the timing is an interesting question on this, and in the meanwhile we have to live with the reality of digital service tax, and I think it will impact to a large extent the way transfer pricing will be addressed in respect to the distribution, or let's say sales function locally by the big tech multinationals. And that's what we see as well. Those processes have already started. I think the interesting one, maybe running a bit faster through the rest of the list. The interesting one was the Uber decision. So the UK Supreme Court has ruled that Uber drivers are workers, not self-employed. So that, I mean, it raises a lot of questions about the value chain of these digital platforms, and definitely this will not be the only business that relies on kind of the interaction between the platform or marketplace and the individuals. So most probably some of these elements will go beyond, let's say, the employment rights, the minimal salary and things like that. It might get to our attention through commerciality of those operations and the value created locally. There definitely a post-Brexit initiative, the UK government's position on focus on fintech. We have done a webinar last week about the UK fintech space, so you can definitely check it out if you haven't so far, and drop us a message to get the recording on that. Effectively, it means there will be a preferential regime. There's a VAT implications there, but that VAT implication for fintechs might lie on the way the intercompany transactions are structured between UK and the rest of the world, including EU. The regulation, I think this news has been populated quite widely. DAC 6 has been scrapped, or at least most of it has been scrapped. So including the transfer pricing provisions where we would have to report in the UK under this DAC 6 regime, the transactions would involve safe harbors, the transactions that involve transfer of high hard value intangibles, and transactions that have to be reported on the basis of restructuring or material restructuring taking place. Those rules are still in place in the EU. UK decided that, okay, we don't need that information. HMRC doesn't need that information, and unless it's connected to the beneficial ownership things, which are kind of more in line of OECD style reporting, which was suggested. There will be a sigh of relief on some people in the UK in terms of the constant challenges from EU on the EU state aid position. Obviously, UK falls outside of that challenge right now, although there will be some trading implications in the way UK can support businesses. There was an interesting in talking about more about refinement of regulation, and that will definitely be felt in fintech and crypto. But there's also some voices in UK which are pushing for new fund structures, or let's say the old fund structures that work, let's say, in Luxembourg. But they say, okay, let's try to onsure that asset management industry, let's onshore the funds. And most probably, as part of UK being at the forefront of financial services, they will want to get more of a business as opposed to splitting that business with asset management. business with Luxembourg or Netherlands or let's say offshore jurisdictions. So that there's a space to watch on this one. The downside of Brexit, I mean, for tax reasons, the UK businesses can't rely on the EU arbitration procedure, so everything falls to the MAP procedure, and it's a big question, how will that affect the number of cases being resolved successful or the timing of cases being resolved, but that's one of the downside. The cross-border merger relief that doesn't apply anymore, and at least the UK has stated that it applies from the UK side, but it's quite unlikely that the EU will allow for the same treatment going forwards. And then in terms of COVID, I think there was a lot of, not a lot, but there was some recommendations coming from OECD. There's definitely a number of jurisdictions have spoken about the COVID implications on transfer pricing. HMRC have noted the position on permanent establishment rules, but their position was, guys, we have the rules which allow some level of flexibility that relies on some kind of reasonable position. This should be enough. And that's a big question, if it will be enough, or there will be some cases that businesses will be pushed into the triggering permanent establishment in certain in UK, just due to the fact that the COVID regulations, the COVID restrictions have been in place and people can't travel freely anymore. And finally, so during the last, let's say 5 to maybe even 6 years, even before the Brexit was on the cards, there was increased focus on tax evasion and even tax avoidance or aggressive tax avoidance. That is continuing, and in the light of the Brexit, in the light of the COVID, in the light of the slowing down economy, there will be there will be potentially a hike in corporation tax, pending the budget tomorrow. But there will be even more pressure for HMRC to deliver those numbers and to put the light on and challenge the aggressive tax planning or tax avoidance, or the perceived aggressive tax avoidance. In terms of these new tools, there has been a new profit diversion compliance facility, which is linked to the diverted profit tax, which we will discuss. But effectively, under this facility, HMRC is sending hundreds of nudge letters to the businesses, saying, hey guys, we don't know if you are triggering diverted profit tax rules, but we feel that you would benefit of applying for this profit diversion compliance facility. Please register. And based on their communication, a large number of these businesses have used that facility. Effectively, it means some reduced penalties for the let's say voluntary contributions to the UK budget. One interesting development which has been also picked up by Financial Times is that now there are a number of cases that HMRC has raised criminal charges in transfer pricing cases, which is maybe not unusual in rest of the world. It's definitely a big change of position in UK. So everybody is here, have heard the stories about Italian tax police barging into the office with automatic guns. Obviously, HMRC is very far from there, but the fact that there would be certain cases where HMRC sees some mistakes, some aggressive positions being taken, some misrepresentations, and I guess with the misrepresentations with transfer pricing, it's hard to say, is it just transfer pricing storytelling and trying to present it as it is, or it is pushing the truth too far. And I think as advisors, we try to tell the story based on facts, but I guess either there's the taxpayers we don't who don't base it on commercial reality, or actually HMRC is trying to ratchet up the pressure through this criminal charges, and I've heard about cases being similar to that, where the criminal charge was floated by the HMRC in order to, let's say, put a bit of pressure on the taxpayer to pay up or settle in a more favorable way to HMRC. And then finally, the rebalancing of budget, which will be definitely a big task for the government in the next few years. Yes, we are waiting for the budget, hearing about the increase of corporation tax rate, but most probably some of that rebalancing will be through the audits and trying to put the perceived tax avoidance contribution back to the budget in the UK. And maybe if you can move on now to a different to the next slide. Let's put about what is the focus of the HMRC and the government. I think the interesting number on this slide is the 36.9 billion that has been an increase from 34 billion the year before. We're talking here about the cracking, kind of cracking the whip on the tax avoidance schemes, and not only schemes, but obviously potentially some transfer pricing and diverted profit tax charges. In this respect, the focus here is definitely not on kind of a case-by-case situation where a taxpayer misrepresented let's say, took a position which is in the gray area. The perceived position is that there is a significant portion of the tax avoidance happening, and also tax avoidance related to transfer pricing, which HMRC has to kind of shake properly. And the number, which is not on the slide, but recently reported, that the estimation of how much tax avoidance, the amount of tax avoidance and the loss of revenue in the UK have been, I think it was over 30% increased year on year. So meaning the estimate from the HMRC, from the government, is that there's a lot more or increasing amount of tax avoidance they have to audit and get back from the taxpayers, which is an interesting position. I guess we can move on to the next slide. So we're going into the statistics now. So I'll try to get through this fairly quickly, but just maybe pointing out the interesting bits of information in there. So in terms of the APAs, you can see that in last year, so we're talking 2019, 2020, the average time to reach an APA agreement is 48 months, or 4 years. I guess partly that could be explained by the fact that there were some older cases being resolved that particular year, and it kind of increased the reported duration. But there's definitely, based on our experience and the experience on kind of talking to other professionals, is that HMRC is quite unwilling to commit. They're very careful. They want to scrutinize a lot of aspects, and then the information they request and the level of detail they want to get into extends that period under which it can be agreed. I think there's still going to be cases where APA is the best course of action and can be resolved fairly quickly, but we're talking about 2 years fairly quickly, maybe not half a year fairly quickly. Most notably, and based from my experience as well, the ATCA process. ATCA is effectively a UK version of APA for a financial transaction. It's called Advanced Fin Capitalization Agreement. It used to be, 5 years ago, it used to be almost a standard procedure. If you do a big financing deal or a financing transaction, you go to HMRC and would agree. It wasn't simple, but it was a standard procedure which would take maybe 12 months, maybe a bit more, maybe sometimes a bit less for simple ones. what I saw in the last 4 years, it got a bit more and more difficult to get it. And in particular, the way it got difficult is that HMRC would want to deal with, get certainty of all different other aspects of that transaction, whether it would be an allowable purpose or kind of the anti-arbitrage rules or any other position they would see as a question before they start talking about transfer pricing. So if you want to agree quantum and percentage of the debt, all of a sudden you're answering the questions about an allowable purpose, and I guess that extended the period of the agreement, and you can see from the numbers in 2014 the number was 213 ATCAs agreed during the year. In 2019, only 45 ATCAs were agreed. So there's a number of other elements that come into this drop, but it's just a stark result, which just shows increased scrutiny from HMRC. If we go to the next slide, the TP yield, increased a bit from the 2018-2019, but it just shows the kind of, you can compare it to the yield, let's say in 2014-2015, you can see that the number kind of jumped over $1 billion. And the reason what changed during 2015-16 and 16-17 is that diverted profit tax regulations were introduced. And this makes so much easier for HMRC to say, we have a dispute about transfer pricing. We feel that we have, and this is stated by them as well, we feel that we had enough discussions about transfer pricing. Actually, there's a diverted profit tax element. So if you don't want to pay up, if you don't want to kind of, and that's the interesting bit about the diverted profit tax, that you have to pay in advance before you settle a position. If you don't want to pay now and pay at the increased rate and potentially pay penalties, let's agree on transfer pricing. And that's where that increase comes from 4 years ago. The average settle inquirers also show the increase, and I guess one way to see it is in the last few years that they were able to have that different framework and different discussion with the taxpayers due to the diverted profit tax introduction. But that's kind of, again, shows the position and the discussions that are being had during the audits. Maybe let's move on a bit more. That's just saying the same thing. Increased focus on diverted profit tax, increased focus on this new compliance facility, which is based on diverted profit tax, and this kind of relies for the taxpayers to self-assess, to report profits they haven't reported before. Again, we're talking about 100 investigation in diverted profit tax, and that generally tends to be big numbers and big disputes. In the next slide, MAP. So as mentioned, the EU arbitration will no longer apply from the 1st of January 2021. And then the MAP numbers, those numbers include the EU arbitration. So it's a big question, what's going to happen next? Yes, there's this COVID effect of tax authorities maybe not being able to work properly in the first half of the 2020, but effectively it seems that HMRC was quite good to adapting their ways of doing business. However, it's anybody's guess how this resolution of double taxation would going forward, because all of a sudden all the EU countries that settled the disputes under EU arbitration conventions with fixed, let's say, limits will rely on the MAP. Granted, MAPs have improved drastically, but it's there's definitely let's say less walked path in terms of these discussions than the EU version of it. Okay, so I think I will stop here and maybe ask Rudolf, does anything said up till now kind of strike a note, or what is the perception of HMRC in the continental Europe and do these statistics reflect the perception? Rudolf, you need to unmute yourself.
That does help indeed. Thank you. Indeed, Arnas, from a continental perspective, I think it's useful to know that the APA program is up and running. It has been for a number of years, both in the regular industries and the financial industry. So both programs are there. There's even a MAP program on top of that, and it may not be anymore an arbitration program. That is fully understood. I think what would be useful to know from a continental perspective is also in terms of say foreign investment into UK, whether these programs will still be up and running in the next couple of years, and whether they may even be simplified a bit, perhaps in order to attract new business. And a question that came up on this, effectively there's a few more than just one, is whether apart from APA programs also agreements with a local tax inspector can be made. I think in continental Europe that does happen. It still does, even when there's APA programs available. Not all agreements are being made centrally, so to say. Then finally, before giving over again, Arnas, a question that additionally just came up. Is there a divergence between UK transfer pricing rules and OECD TP guidelines? Oh, that's a good one. If so, what are the key differences? Nice one, thank you. You go ahead, Arnas, please, on this.
So maybe I'll take it in the order you asked them. I think for the direct direct investment into the UK, I think there will definitely be a priority and a way to attract the business to the UK. There's the government has clearly indicated there's this few key areas they want to attract business in. And those will be prioritized. In terms of interaction with the HMRC, what we see is that HMRC, it's almost, if you have a CRM and you have good relationship with CRM, meaning you're a big taxpayer, a large taxpayer, and you have this customer relationship manager, it's a very good and positive interaction. They are supportive through COVID restrictions and the changes that were required. They are supportive in walking the business through the Brexit implications. And there's an arm which is effectively a transfer pricing / diverted profit tax division of HMRC, which are very aggressive and they don't play games. And that's kind of the duality of the approach. So I think they will still continue to be business friendly for people incoming and trying to support through the process. But as soon as they feel that there's some sort of, let's call it profit diversion or tax avoidance, then another arm of HMRC comes in and something to be thought about when new businesses start. But I think it's not unlike other countries and what we might expect from other countries given the budget deficits. In terms of the agreements with the local tax inspector, it basically is centralized. So all the ATCAs, all the APAs go through TP panel, and they have to be agreed and stamped by the TP panel. So the official APA program, you can't agree at the local level. And it's definitely, as everywhere, a priority or a preference for the bilateral APAs. One thing to mention is that, again, with the CRM, where you do have that relationship with HMRC, you can discuss the topics quite freely. And obviously, it gives you a bit of a gauging of what kind of position HMRC might be having on one particular issue of a different or a different issue. So yeah, centralized, but there's a kind of ongoing relationship for some of taxpayers. In terms of divergence of the OECD guidelines and UK guidelines, I think UK was always a bit of at the forefront of certain elements of TP recommendations, let's say, or regulations. You can definitely notice that a lot with the new financial transactions guidance from OECD. A lot of that was already in the UK transfer pricing guidance. I wouldn't expect UK diverging just because they will try to be, as indicated, less regulated, more about reasonableness, right? So they say OECD gives a very good basis. We will kind of use the case law where there's certain difficult questions, but other than that, I wouldn't expect a lot of divergence between the UK and OECD in terms of transfer pricing regulations. So I would maybe want to say a few things about BlackRock case, and then we can jump into the case study. So the BlackRock case was quite publicized, so I'll try to make it brief because maybe a lot of you already heard this. I think it was a decade ago, BlackRock has acquired Barclay, an arm of Barclay investment business. And in order to fund that acquisition, they have financed part of the acquisition through the acquisition debt financing coming from a shareholder. That's a very usual structure in UK, especially at that time. Effectively, HMRC looked at that and said, well, actually, we don't like that. And we don't like that for a number of reasons. I mean, there's a lot of complexity about why they didn't like it, but effectively they're saying like there would be no third-party lender who would be willing to lend this amount. The amount was, I think, 4 billion, which is a huge loan for capital markets. After a long discussion, the court decided that actually the taxpayer showed enough proof that this funding capacity coming from debt would be available for this acquisition. And, obviously we're talking about big business, we're talking about a very established business, we're talking about very profitable business. So there would be willing lenders to do that. There was a discussion about whether, and we're talking, this funding is obviously not obviously, but it was on top of the bank funding for a portion of this acquisition cost. So we're talking about kind of a more risky loan. And the outcome was that, maybe this kind of funding would have a lot of covenants, which would make it too costly to actually get it. But again, the judge ruled that it's fine and understandable that they didn't include that covenants, but obviously there should be some consideration about pricing that in. There was, in addition to transfer pricing implications, there were unallowable purpose discussion. As with so many challenges or discussions I've seen in my career with the HMRC, unallowable purpose was definitely seen for a better part of the decade as a tool for challenge to explore and try to apply successfully. Unfortunately, in this case, or fortunately in this case, I don't know what's the word there. HMRC wasn't able to prove it, namely that because the acquisition was a real commercial purpose, obviously the shareholder loan was partly for the tax benefit, but the commercial purpose is there, and you can't say it doesn't satisfy the allowable purpose threshold. So I think in brief, I think those are the key elements. Again, I think a lot of you were aware of this one, so I don't want to spend too much time on it. And then we can maybe go and have a discussion about the case study, which would involve a reorganization of the operations after Brexit. So just to present it, I mean, we're talking about a very generic structure, very simple structure. Let's say there's a group with an Irish HQ and the UK operating company that does manufacturing and sales. Obviously, with manufacturing, there's a lot of parts maybe coming from EU. And in this particular case, UK had a very significant operations in terms of sales, in terms of production planning, inventory management, and other key decisions on the business, and was selling to other countries as well. So if we look at the situation post Brexit, you would in the next slide you would see that, okay, right now, because of a number of reasons, part of the manufacturing moved to Ireland, and some of the sales at least moved to Ireland in terms of the EU sales. So that opens up two areas of discussions. Like first is the restructuring implications, and then the second one is, let's say, what challenges might a group like this be facing after Brexit in terms of kind of maintaining some or similar presence in UK in terms of the decision makers, but maybe not as much as manufacturing and sales, and what areas they have to be careful about. At this stage, maybe I'll ask Rudolf, what, do you see this often? Do you think this is kind of a good case study to be discussing in terms of the Brexit, and what elements you would be looking for from, let's say, continental Europe perspective, or Ireland is in this case, to in terms of these two big topics, but maybe some other ones as well.
Okay, thank you very much. Thank you very much, Arnas, on this. Indeed, this although seemingly generic, it does entail quite a number of transparency questions already. I think this has been going on for just a few months, or close to 1 year, perhaps, for the majority of our clients' relations. Some of them have made the step a bit earlier, but the vast majority is basically now in its first step of considering our day-to-day practice, what needs to be taken care of, customs duties, transportation of goods, logistic measures, and so on. So I think at this stage, Arnas, most of the questions that we arrive at from a continental perspective are more on a day-to-day business, like, for instance, but a bit beyond that, like, for instance, customs duties may go up in terms of Brexit. That may have to be absorbed in the cost base of the manufacturer in the UK, and how is that then resolved? Is there any reverse charge mechanism on customs duties? Well, perhaps not. Should it be absorbed in the cost price? Possibly, yes. What does that mean for an uplift? Also in terms of benchmark studies. Benchmark studies going forward, would that mean EU including UK still, or is UK manufacturing too different from continental Europe going forward to still include in a sample set of companies in a benchmark study? So those are the more, say, straightforward type of questions that we arrive at today. Looking at the broader picture that you have scheduled here, yes, definitely, questions do come up in terms of valuation of a manufacturer, of a sales company going forward. Does that mean an exit charge or not? Is there any other means to go about this? Well, we may not have seen the combination UK-Ireland, although logical from a UK perspective. But we do see combinations of UK with Netherlands, UK with Germany, UK with France, obviously. So all these questions, yeah, they do come up. And a question perhaps for you, Arnas, do you think that the OECD guidance on this would be appropriate enough to give answers to these questions? Or do some of those need to, real guidance by, well, basically by you in an APA program or so going forward?
Thanks, Rudolf. I think there's a lot there to be touched. What you mentioned. I think let's start with thinking about how those operations after Brexit would look like in this case. Okay, so UK most probably was a profit center before. They manufactured, they sold, and they sold all across Europe. In this case, they would potentially allow for Ireland to either take the full profits, given that there's loss of some manufacturing and there's loss of sales, which you might even imagine that UK becomes a contract manufacturer for Irish business selling to the EU. Let's assume that's the case, and then the questions about benchmarking would definitely be, and let's say the comparables you would look at, the customs cost that UK would incur becomes interesting. In this part, in terms of the guidance, I don't think there's definitely the standard OECD language about the kind of the government intervention and things like that. But there's no additional guidance or detailed guidance on what happens in case of Brexit. I think it's a very unique event. In this case, a lot will depend on the profitability in the UK of other businesses, of independent businesses that are selling to other countries. And to be honest, when you think about it, there will be competition between, let's say, UK and internal EU service or product providers, and most probably the UK businesses importing into EU will face increased competition and will maybe even have to absorb the custom costs on the components that are being used in production of these things being sold in EU. So there might be pressure on the manufacturing industry overall, and that would potentially be reflected in this contract manufacturing arrangement between Ireland and UK. Thus, the answer would be maybe looking at the data in the UK would be more appropriate than looking at the EU-wide data. And before, let's say, HMRC had a fairly reasonable position on the benchmarking in terms of, is it European set okay, or is it the UK one? Obviously, you can have a slight preference on the UK comparables, but generally European searches were fine. In this case, maybe there's a chance that HMRC would insist on the UK comparables because of one reason or another, or potentially, the UK businesses, let's face it, will struggle for a while, and maybe some businesses won't have the employees, and businesses will close off, and the remaining set, there will be a survival bias of increased profitability in the UK. Again, something to consider, and would give a reason for HMRC to say, well, you can do a EU-wide search and get a cost plus 5. In the UK-wide search, you get 7 or 10 because the survivors actually are more profitable. So those are the considerations. I think in terms of the one thing to maybe delve is the sales activities. Imagine in this situation, Ireland starts booking the sales. They also are responsible for partial of manufacturing, so profits remain in Ireland. So what you get that potentially UK still employs the salespeople who sell to the EU, but they are not getting the profit. UK entity is not getting a profit, and you could argue that okay, so there's a transfer pricing issue there, but I would want to emphasize that in this particular case, there would also be a diverted profit tax challenge there, because effectively the profits allocatable for the UK based sales, not to UK but into the Europe, would be booked in Ireland. Ireland has a low corporation tax rate, which effectively makes it less than 80% of the current UK rate. And then in a challenge like that, the taxpayer in the UK might face not only a transfer pricing challenge, but also a diverted profit tax challenge. So in this case, I just wanted to show the interaction between transfer pricing and diverted profit tax. Obviously, diverted profit tax is a very, very broad and complex rules, but that's why you almost can't solve just for transfer pricing. You have to start thinking about diverted profit tax as well. And I think similarly, in terms of the, let's say, the ongoing operations after such a restructuring, there's a question about whether Irish companies should remunerate UK for the, let's say, transfer of profit potential. But in addition to that, there's a question like, if for the activity that was transferred, there's lack of economic substance in Ireland, again, diverted profit tax rules kick in potentially, and there's ability for HMRC to challenge this transaction, not only through like exit taxation, not only through transfer pricing, but also through diverted profit tax, or by sending a nudge letter under profit diversion compliance facility. So again, this makes the analysis a bit not unique, because there's other countries that have diverted profit tax. Australia, for instance, one of them. But let's say in the context of EU, it's quite an interesting angle, and we should be aware of it. I think we still might have let's say if there was transfer of know-how and some intangibles, there might be hard to value intangibles question, and potentially DAX 6 reporting would still have to be made in Ireland, as it is still part of EU, although in the UK rules do not apply. So something for the UK taxpayers to be aware of, even though the rules of DAX 6 don't apply here, there's still other countries that you have to report in. So these are kind of the key elements I wanted to mention. Hopefully I covered the aspects you raised as well, Rudolf, but maybe there's other elements in this structure or in the other parts of presentation you would want to raise again.
Okay. Yeah. Thank you, Arnas. Indeed, a couple of questions that still have come up. I think those are more about attracting new activities in UK. So perhaps not so much on the restructuring schedule. Pillar 2, here it comes again. Question is in attracting new activities into the UK, what position might UK government take as to, for instance, Pillar 2, and then think of investments out of, say, Middle East or so, or offshore type of jurisdictions where Pillar 2 might really hit hard, so to say. having UK in between the true investment and the investment fund ultimately. Question is broad, I think, by the listener. So, any thoughts, Anas, on attracting new business, and obviously Pillar 2 is an example. Diverted profit tax has been requested as well. What may be the near future of diverted profit tax in this sense? So perhaps you take a step on those matters.
Very interesting questions. I guess the idea or the proposed benefits of Brexit does extend from, let's say, being more open to the rest of the world. And I think the investments and businesses coming from the Middle East would be as part of the focus of the government, and thus potentially lead into these new businesses set up in UK. I think, as mentioned, and as I repeated numerous times in this webinar, diverted profit tax is seen as and is used by HMRC often, and to some extent it talks about that below the threshold profit tax charged on the profits that might be allocatable to UK. So, you know, if the Pillar 2 would not be put in place, HMRC still has a tool where, for a UK business which has the people in the UK but operates, for instance, and records profits in Middle East with a low taxation, those would still be captured, and you don't wait, and you know the HMRC doesn't have to wait for Pillar 2 to happen. I think to some extent diverted, let's say, Pillar 2 is still linked to that digital service tax, just sales tax, and then the bigger discussion on the international community will, where HMRC UK still is heavily involved and still wants to be seen as a forefront, will be interlinked with the post-Brexit trade deal discussions UK is having with the US. And you know, we have some news on maybe challenges coming from US, the discussion about trade deal being postponed and things like that, which will definitely affect the position of UK and how they either push for let's say Pillar 2, or maybe hold back to kind of side with US or some other country because they have trade negotiations there. So, you know, sorry for a vague answer, but I guess to a large extent we have to wait and see.
Okay, thank you very much, Anas, on this. Okay, ladies and gentlemen, Anas, then we are about to come to an end to the end of this today's program. Thank you again for being with us today. Upcoming webinars are noted here. Please do have a look at our website or the newsletter once in a while, because this definitely is a dynamic set of programs that we have. So if any webinar is of your interest, please do let us know by sending a short email to qgacademy@conteraglobal.com, indicating which webinar you would wish to follow. I think we have covered ground to at least most of the questions raised throughout the program and shortly before. If there's any questions still coming up, please reach out to Anas or to me, and we'll take it from there. Thank you very much all. Well, that's sharp, 1 hour time. Thanks again, and till next time.